This week on the Business Owners Corner, I'd like to talk a little bit about investing in international stocks. So that's investing in the stocks of companies domiciled in countries other than the good old United States of America. And the reason for that is it seems like every single time I review someone's portfolio recently being over the last 5 years, every single time I do so, that portfolio is far overweight and weighted very heavily in US based companies compared to non US based companies. And you might say, well, that's what I want. I live in the United States. I like the United States. The US has the strongest and most diverse economy in the world. Our markets have done better. And to that, I would probably agree with you because all of those things are true. But that being said, this goes back to using the benefits of diversification to your advantage, minimizing risk where you can. Even though the US has produced the best returns over the last decade, that's not always the case. It's not always going to be the case. And in general, when the US markets zig, markets of other countries tend to zag, or at least not zig by quite the same magnitude that the US markets and corporations might. So that being said, it's very important for diversification purposes to have an allocation to non-US equities, just like you do US equities. Typically, stocks in other countries are divided into two categories: developed markets and emerging markets. Emerging markets are less developed economies. They don't have the same infrastructure, the same intellectual property rights. More developed economies, now you're talking about Germany, Japan, Australia, Mexico, Canada, countries like that that have been around for a little bit longer with some more economic stability. You need a little bit of both. The way that the markets exist across the world, if you weight them all by market capitalization or which is a good proxy for size, the US represents about 57 to 60% of the world's global market cap. The other 40% is elsewhere. And that's a pretty good split to begin with. Again, the US has done better recently. That's not always going to be the case, and we want to use the benefits of diversification to our advantage. Another thing you need to scrutinize is if you decide to invest in non-US companies or non-US funds, I should say, whether that be a mutual fund or an exchange-traded fund, an ETF, you should look into whether or not the currency exposure is hedged at the fund level. Most are not. This year, particularly, is somewhat interesting because markets in non-U.S. countries, both developing and developed and developing, have done a lot better than the markets here in the U.S. But since the value of the U.S. dollar has gone up and up and up, the value of the dollar is very strong right now. If you invest in an ETF that covers the rest of the globe and doesn't hedge for its currency exposure, after bringing those returns back into US dollar terms, the funds haven't actually done that well because the dollar has gone up in value over that same time span. Now, some people prefer to hedge the currency and not take that risk. Others prefer not to. You do get a little bit more of a diversification benefit, I think, if you choose not to hedge the currency exposure. The downside is you get years like this where international markets have really done much better than US markets, but you haven't gotten to benefit from it because the dollar's been strong. So a couple things to think about. Everybody needs some non-US countries in their portfolio. There are ways to omit countries that are more autocratic that you might not like. A lot of people are uncomfortable investing in Russia or China right now for good reason. There are ways to omit those from your accounts if you like. The point is that diversification can be your friend. You just have to be patient with it over time.